Hey everyone, so today is a landmark day. Let me explain. For the past 6 months since I've returned, Beer Money Engine, the channel, has put a lot of focus on Beer Money, that is, these reward Beer Money apps to build a Beer Money portfolio. Today, though, we are finally going to start putting a little bit of focus into the third word, engine. In other words, Money Engine. I have described this in a video back in early December, that someday we are going to put a focus on this, but we needed to have enough money to do so first. If you had started even just casually playing with your phone over the last 3 months, substituting cash for gift cards when you buy stuff from Amazon, Walmart, or Target, and saving that cash into a savings account, or just straight up getting cash like Bridge Money, Benjamin, Swagbucks, and Atlas Earth do with their PayPal or Venmo options, and I think actually some of them even do crypto now. I believe Free Cash does that. You should have more than enough cash now to open up a banking or brokerage account at this point, with a few rare exceptions. Of course, we're not going to be going to those exceptions. We should be dealing with stuff with no or very little minimum balance. So anyways, that being said, that is what we're going to do with this portfolio. We're now going to start talking about the engine in Beer Money Engine, and that means it's time to invest our money. To start, we need to know how much money we have available to invest in the portfolio, and at this point, we're at around $400.16. $200 of our portfolio is currently stashed in a Quicksilver Rewards secured credit card, and that money will be returned to us around October or November of this year, once it's turned unsecure, leaving us with $200.16. However, that is more than enough to start investing. So we have several options that we can use to invest, and I'll eventually get to them all. However, I feel like the foundation of every good portfolio needs to start with total market index funds, either in the form of ETFs or mutual funds. So they're very similar to each other. ETFs stand for exchange traded funds, and mutual funds are basically mutual funds. You guys are pretty used to that. They're a little bit, I call them like the father of ETFs in a way. And they are about as safe as can be, since total market index funds consist of a small piece of every single company in the country, and for some of the international ones outside of the US, or for the total world market funds, the entire world. And they also have like specialized ones as well by sector, especially with the mutual fund category. And there's even like ETFs out there that involve specific companies or specific innovative companies. Like there was this big ARK craze one time, ARK investing craze. There are two types of these funds: actively managed funds and passively managed funds. Actively managed funds are funds that are actively managed by a professional fund manager or computer, with the goal of beating the performance of a benchmark index, but at a higher expense ratio cost. These benchmark indexes, by the way, are the S&P 500, Dow Jones, the Russell 2000, and so on. Passively managed funds are a collection of securities that replicate the performance of a benchmark index and are able to lower costs. Now, despite some people saying some actively managed funds can beat the stock market one year, it has been shown that over time the benchmark wins about 90+% of the time, mostly because the benchmark constantly rotates out the best and stable performers each year. And so what I'll be looking at for this portfolio are passively managed funds. Plus, they cost a lot less. And not just any passively managed funds. I want to follow a total market 3-fund portfolio popularized by the Boglehead community. Boglehead is a term for followers of Jack Bogle, the founder of the Vanguard Group, who is credited with popularizing the index fund. His advice had been to only focus on having 2 funds originally, a total market US stock index fund and a total market US bond fund. But nowadays, Bogleheads do add on a total market international index fund as well, thus the 3-fund portfolio, and there are some that even talk about a total international bond index fund for a 4-fund portfolio. Now, I plan to eventually diversify out the lion's share of these alternative investments once I hit around, $1,000 or so. I-bonds, a little bit of crypto, silver, gold, and real estate. So this overall should mean I'm looking at other alternative investments being more conservative, since I-bonds and CDs will make up most of it. So since my alternative investments are going to be more conservative, I'm going to go ahead and go a little bit aggressive with this stock portfolio. Well, I should say fund portfolio, and do an 80 stock, 20 bond allocation. As far as US versus international, I'm going to, and I know that Stonks for Days is going to flog me for this. I'm going to go down the middle of Jack Bogle's advice of no more than 20% international allocation and Vanguard's advice of no less than 20% and just do 20% international allocation. Now, just a personal disclaimer here, I personally use 30% on my 401k and 40% on my Roth IRA, but I'm trying to think through the eyes of a newbie who is just trying to learn from what they see from Google. Again, personal strategy, just all around. So 20% it is. Now we're going to cross multiply this. That means that our starting portfolio should have 64% put into a total US market index fund, 16% into a total international market fund, 16% into a US bond index fund, and 4% into a total international bond index fund. However, 4% is kind of small when I only have about $200 to start with. That's only $8. I don't even know if most places will even let you order that little money these days. I mean, I know M1 Finance might, Fidelity's UI maybe. I just didn't want to take a chance, so I decided to hold off on buying international bond index funds for now until I have about $500 stored up in the brokerage account, and then I will put in $20 basically. So that 4% is going to go into the total international market stock fund, and I took 4% from the US stock fund to put into US bond fund so I can keep that 80-20 balance. So for right now, we're going to start off with 60% to the total US market fund, 20% to the total international market fund, and 20% to the US bond index fund. And again, as soon as we hit $500, I will put $20 into the international bond index fund of my chosen brand and try to rebalance it the best I can without having to worry about taxes. Now, as far as which company I decided to choose, I found the 4 companies most people rave about for these total market index funds, and they are Vanguard, BlackRock, State Street, and Fidelity. So the first 3 are known better as the big 3 as far as passively managed index ETFs are concerned, and the 4th has a passively managed mutual fund. BlackRock is better known as iShares, and State Street is known as Spider, on the markets anyway, when you select their brand of ETFs. Between the 4 and trying to find the lowest net expense ratio, I have the numbers here of each fund and my final eventual allocation, and it seems Fidelity wins out with an average of less than 1/100th of 1%. And above it, I show, given a $1 million fund, how much a year it will cost you with the net expense ratio. So State Street seems to be the worst with $524 a year off. BlackRock has $428 a year, Vanguard at $396, and for Fidelity, $64. However, because Vanguard is so popular and is the cheapest of the 3 ETFs, and Fidelity's funds are entirely down to you must use them in order to get it, it was a little bit tougher than I had wanted to admit, basically. So I left this to the community to see what they liked best between Vanguard and Fidelity, and I would go with it. And originally, it looked like we were going to go with Vanguard with a 65-35 victory. But then M1 Finance dropped a huge bombshell that they were going to make M1 Plus features, that was their premium plan, free for anyone who had more than $10,000 in assets with M1 Finance. However, for those with less than $10,000, it was going to cost $3 a month, and you don't have a choice. You wouldn't think $3 a month sounded like a big deal, but considering this portfolio, I'm going to start off with about $200 and maybe add another $100 by the end of this month and maybe an extra $150 per month after that. You got to think that, like, even if we got to December, that would be like $1,400 we put in. And at $3 a month, we're talking $36 a year. So that's like, if I did my math correctly, that's like a little over 2.5% for an expense ratio, which is way higher than BlackRock and especially way higher than Fidelity and Vanguard that we have to tack on to it. So despite what the polls say, I'm going to go ahead and go with Fidelity, and I'm going to go with their mutual fund. Sorry guys, but Fidelity just has overall better bang for the buck for the low net worth we have in this portfolio right now. And even if I could find an app similar to what M1 Finance used to be, Fidelity still beats it out with their zero fee net expense ratio. Maybe once we get to $10,000, I can switch it up and move to M1 Finance and move to Vanguard. But for now, I just can't justify paying what I'm calculating is going to be roughly, I don't know, about 2 to 3% a year, at least for the first year anyway. But this way, we also have a nice even number. It's 60, 20, 20. 60% US market using the Fidelity ticker FZROX. We're going to use 20% for the International Market Fund, which is the ticker FZILX, and 20% for the US Bond Index Fund, the only not zero fee fund that I have, with the ticker FXNAX. Now, the first two, US Market and International Market Fund, will be no expense ratio, and 20% FXNAX, the US Bond Index Fund, I believe only has like a 0.025% or something like that. So yeah, we're going to go with that. And now I'm going to show you the results on Fidelity's user interface. So the way mutual funds work is that buying it is not immediate like stocks. At the end of the day, around 4 p.m. Eastern is the only time when mutual funds are bought. You set up the orders in advance, and then at the end of the day, you buy it, which is exactly what I did at the end of the day on Friday the 12th. Today is the 15th of April, tax day, by the way, and each day, the price of the funds will change. It is not immediate. This is how ETFs were like before ETFs were a thing. It's slower, they just take the daily prices. And yeah, we were going to do something similar like this with M1 Finance because they actually use 2 trade windows a day where you set things up accordingly, very similar to a mutual fund. It's not an immediate like buy stock and then watch the price go up. But again, the high expenses. So I went ahead and I deposited $200 in. $120 to the U.S. Total Market Fund, $40 to the International Market Fund, and $40 to the U.S. Bond Index Fund. And here I am showing you the end of day one, and we're not off to a great start, everyone. The S&P 500 on April the 15th had dropped about 1.2%, and the total market responds in kind by dropping 1.23%. I also lost 0.61% each on the international and bond index funds, and that gives me an overall total loss of 0.99%, or about $1.98 today. Now, to be fair, it's not bad, all things considering, and with Bridge Money's Earn Plus and more Benjamin and free cash money coming in, that 1, 2, 3 punch might allow me to go ahead and deposit a little bit of money to dollar cost average if prices, the stock prices, I should say, keep falling. And I'll be talking more about that if the S&P 500 starts dropping any further, say to correction levels of 10% off the top or even recession levels of 20% off the top. I think they call it now bear market levels, so 20% bear market levels. And I'll show you guys the power of dollar cost averaging then. I do want to do it either way sometime this year, though, for a personal finance video. But I've used up more time than I planned on doing so. This is just the beginning of the personal finance segments that I plan to do on this channel at least once a month, around the middle of the month or so. This is the part of the channel where you guys will actually learn how to use that money to make money, not just in watching this number go up here or down in this case, but getting dividends as well, and those dividends allowing you to make more money on top of that money. But we will have a 101 on the stock market, mutual funds, etc. And a lot of you probably already know some of this anyways. If you keep watch of your 401k, your Roth IRA, or even if you've bought or staked some crypto, especially the staking crypto part, there's similar concepts to it regarding like dividends and stuff like that. Anyway, that's the video. Next personal finance video, I plan to talk about how I personally save my money and how I view savings in general. That will be next month. Anyway, I hope you like this video, this little introduction to the world of the stock market without having to tell you what to get, because again, read my disclaimer on the description. This is just what I'm doing and my own personal strategy, and a little bit of learning by doing as we start the process now of making the money we earned from our free time work for us. Don't forget to subscribe to Beer Money Engine. Comment what you think of this video. Please do let me know, because I really want to do these personal finance videos and I want to make sure that I do them right. So let me know what else you would like to see, and I will see you next time. Bye, everyone.